I just want to get your general take of what's been happening with the likes of Credit Suisse, Silicon Valley Bank, yada, yada.
Yeah. No, I have so much respect for Caitlin and Lynn's opinion on all this, giving the details to it. What I would say is putting my regulator's hat on is it's an overcorrection from 2008, just the way 2008 was an overcorrection from the Great Depression. So in 2008, you had...
Well, hold on. That's some take. We're going to have to go back a sec. Okay, you need to explain this to me. 2008 was an overcorrection from the Great Depression?
Yeah, sure, absolutely. So Ben Bernanke, who was the chair of the Federal Reserve at the time, it's well known he was a student of the Great Depression. He studied it, night and day, understanding what happened. And his determination, he said this publicly, is that there was a credit stopped flowing in America. 30% of all the banks shut down. 9,000 banks shut down during the Great Depression. There was a seizure of credit. You couldn't get a loan to start a business. You couldn't get a loan to get a house. Business wasn't able to flow, and that's what really caused the U.S. to go into this collapse and required the New Deal with FDR. So with 2008, right, that was under Ben Bernanke's watch. He said, we have to avoid a Great Depression scenario at all costs. So we have to make sure there's a flow of credit. Thus, we recall, and Caitlin Long's explained this, all the Federal Reserve programs that started adding up this huge debt were created in 2008, really out of, I don't want to say it like this isn't a bad reflection on Bernanke, but out of paranoia of if credit doesn't keep flowing in the economy, we're going to end up like the Great Depression. And so that's where, to me, the overcorrection was the bloated Federal Reserve balance sheet we have now, because the idea was you got to make sure everyone can get credit. Everyone has to keep getting homes. Everyone has to keep starting businesses, get jobs. If we lose that, then we end up back to the devastation of the Great Depression. Was that the correct take? Let's just avoid the Great Depression? Kind of was, right? I mean, it wasn't like let's proactively figure out really what's going on with this housing market, but the economy did reach a point where if certain measures weren't taken in 2008, things really would have been shut down.
But, we need corrections. We all know, what is his name? Ray
Dalio.
Ray Dalio. Okay, so we've all seen his video that talks about economic cycles,
Yes.
But we need corrections. If we don't allow corrections to happen in the economy, we're just kicking the can down the road. And if we don't allow for the contraction, we're going to head to a much bigger contraction down the line. But we can't escape that.
Absolutely. I mean, that's to me why I say I think it was an overcorrection, right? It wasn't necessarily the solution for what was happening in 2008, but it was a solution to avoid 1933 all over again. And I think moving to where we are today, my argument about the current thing that happens with banks is saying this was an overcorrection to what happened in 2008. So we just talked about One West, but back to that it was IndyMac Bank, right? IndyMac Bank was a huge bank failure in the West Coast, had a bunch of subprime mortgages. We watched the videos together. We saw the people on the streets. Everything was falling apart because they reopened the bank on Monday. Remember that? We showed Monday, it was chaos. CBS News is criticizing it. The FDIC is contradicting itself. Marty Gruenberg, who's the chair of the FDIC now, was the vice chair of the FDIC in 2008. So he was the same person who's now overseeing this crisis. I don't have what, like Ben Bernanke said about the distinction between the Great Recession of 2008 and the Great Depression that was an overcorrection. What I can tell you is what I saw him do over that weekend with rising it to an emergency, a systemic crisis where he backed all the deposits of Signature Bank, of Silicon Valley Bank, and said all the depositors are going to be made whole, and that by Monday morning it was all basically done, right? Everyone knew people were putting in more money into those banks because they thought it was even safer than JP Morgan Chase because of the promises. That's where you saw Gruenberg saying to himself, and this is me, but I believe this is right, is he had to avoid what happened in 2008 with the YouTube videos at IndyMac Bank. They knew if Monday morning happened, 9 a.m., there'd be total chaos. So they had to control the situation. They wanted everyone to stay calm. And this is now where it gets very dangerous, in my opinion, but also interesting from the perspective of it was more of a social media crisis on Twitter this time than YouTube, and it happened so fast. How can the regulators react in time? Like, there's no bank to go to. Some people maybe still go down to a bank branch, but everyone just goes to do things over their computers. So to me, I think that was a bit of an overcorrection, because now we've put out this notion that not just 250,000 deposits should be insured, but there should be insurance on every single dollar in the system.
So I think it was Troy Cross who recently came out on Twitter. I think he said that the entire US banking system is now fully reserved.
Yeah, that's right. I mean, and that's what's sad is, of course, it's not. The FDIC, the Deposit Insurance Fund, the DIF, only has approximately 1.3% of all of the insured deposits out there. So if you add to the insured deposits, you're going way below 1% of everything that's out there, which is why, Peter, I'm saying that the problem we're having, like with UBS, that ended up acquiring Credit Suisse because they were in trouble, you're going to continue to see these matchmaking events happen. Because think about it. The minute UBS took over Credit Suisse, everyone got calm. The minute you have these banks, Silicon Valley bought by another bank, everyone gets calm again, because the minute it's all of those deposits are owned by another bank, you're then insured again. You're under the system. It's okay. You don't have to worry if you're over the $250,000 limit. So, and they have to do it according to the least cost test at the FDIC, which was overruled that weekend. You're supposed to do it so it's the least impact to the Deposit Insurance Fund. They said it's not going to be borne by the taxpayer. That means it's going to be borne by bank depositors, because the banks aren't going to pay these fees without passing it on, the customers of the bank. And so what you ultimately have is you're going to see large banks absorb mid-sized regional banks whenever one of them is in trouble in the future, because that's the only solution. They're not going to pay out the insured depositors, because the government, the FDIC fund, will just run out of money.
And something that started happening is, like, when you first started to hear about these bank loans that were being offered, you started thinking, oh shit, man, this is going to happen again.
My friends and the people that knew me, I was very scared over that weekend. It hit me. I thought about our show. I just talked about all this. And so there was this is very much this feeling as so I know that we have the Bitcoin maximalists that don't believe in banks at all. But the vast majority of people believe in the banking system and see that as trust. And a lot of people don't realize when you put money in the bank, it isn't really yours anymore, right? But they still think, well, it's just my money. And when you lose that trust, the trust in banking, that's where I started to see, and that's why I think these larger actions were taken by both the Treasury Secretary, Board of the Federal Reserve, and the FDIC to do this systemic risk intervention, because they knew that the trust was on the line. And that's where I think, and so I was a little nervous, but also very interested, as I was kind of in 2008, because I think we are so close to that line that could get crossed, where the public may stop trusting banks, right? Like, when does that happen? And what happens after that happens?
And so you're going to end up with a situation like Argentina, where people don't want to leave their money in the banks. I mean, right. I was out in Uruguay and I met a guy, and he was saying to me that, I think it was his mom or someone, when she bought a house, she bought it with cash. She used to leave the cash in her house. Mm-hmm. And I think it's this weird story, like she almost went out with it strapped to her, sellotaped to her. I'm sure I've got this story right. But look, we're seeing it already. USDC deposits are down something like 9 billion. Danny, you can probably check this. And Tether's up 10 billion. Like, people are not trusting these banks. They're not trusting it, and they want to get their money out. And look, I get it.
Yep. That's right.
Losing your deposits would be catastrophic. Like, to me, to my father, it could be catastrophic to anyone. And, we don't want to see a full-blown repeat of 2008.
I don't necessarily agree. I would say I think we still could have a full-blown 2008. We've had these happen in a matter of days. And what's important is this is the 15th anniversary of the 2008 crisis. We recall it was March of 2008 when Bear Stearns was saved by the government. Everything kind of went all normal until in July, later in the summer, IndyMac failed.
Wasn't it Lehman after that?
Lehman was after IndyMac.
Okay.
Yeah, because Lehman was in September when they went down. So there could be things going on that we're just not seeing yet that could bubble up. That being said, I think we're out of the woods, for now.
Temporarily?
Temporarily.
So what would have happened if they hadn't have done it?
If they hadn't, that means that you had a lot of unhappy people like the Peter Thiels and the venture capitalists of the world who'd be pointing to data of saying, well, now you have all these venture capitalist companies and the people who are working for them couldn't make payroll, lost all their money, pictures of people packing up out of their house and leaving their house, and the trauma that would have been is sort of what you would have probably seen shown a lot of. Would that be correct? I'm not sure, but I do definitely agree that during that weekend there was a lot of pressure from Silicon Valley itself to save the deposits of Silicon Valley Bank. But that was also, I think, to me, slightly self-interested, because you also had people who, 97% of the people at Silicon Valley Bank had more than $250,000 of assets. So, I mean, can we just start calling this a rich person's bank? Like, can we just get over this? Wasn't the normal grandmothers, people, the retired parents who have their money in a bank and like $200,000, maybe they should understand what that FDIC insurance was. You have people who are running operations that $250,000 is not necessarily even of consequence, but 2.5 million or 50 million, and suddenly you only had it in one account. That's not very smart, but then all of that's in jeopardy. That's like you're losing your fortune.
But if you're a company with 50 million in the bank, like, you can't spread that around enough. Like, what are you meant to do? Put it into treasury?
Well, you'd need like 200 bank accounts.
Yeah, you would if you really wanted. A lot of these businesses don't necessarily operate off the notion that you need FDIC insurance. I'm not saying they don't deserve it, but the FDIC insurance is set up pretty clear. It's $250,000 for just one business. If you're an individual, you can have a joint account. You can have your beneficiaries receive it through a trust. You can get almost 2.5 million of coverage if you do it right as an individual. Companies don't get that benefit. I don't think companies get the benefit in the deposit scheme in the UK. I know it's like £80,000, or is it 80 as an individual?
I don't know that. But it's a fair question.
But I think it's 80,000. That's it. Like the UK is kind of stingy on it. They don't give you these options of having it's per person. So you have 80,000 at the bank, in pounds. You have 90,000. You lose that 10,000.
But you can have that with a number of banks. So if you've got like £800,000, I think you would have to have like 10 bank accounts
at different banks.
Yeah.
If you mean different banks, yes. But within one bank, you can have more than just the 250,000.
And so this is where it becomes a scary thing, because I'm trying to operate a business and I've got to make payroll. And even if payroll's 80,000, I have something called a cash flow. I've got to manage that. And I can't be in a situation where I'm risking not being able to make payroll.
Yeah.
And so I start to have to think about, how do I de-risk this for my business? Do I have multiple bank accounts? Do I even start storing money in Tether? Because these are things that kind of scare me. I'm trying to operate a good business here. And also, what happens at the end of the year if we're profitable? We make a good market. What am I going to do with that money? Do I leave it in the bank? Do I withdraw it? Do I keep it in Tether? Do I put it all in Bitcoin? I can't leave it all in Bitcoin because Bitcoin itself is volatile. But to go back to the point that you made, what would happen if this was a different bank, if this was a community bank? If this had been mums and dads and grandmas and local businesses where 97% of them had under $250,000, do you think they'd have saved it?
No.
Of course they wouldn't.
Well, they wouldn't necessarily have gotten more than 250,000 of their deposits unless it was bought to another bank. What I guess I'm saying is the constituency of Silicon Valley Bank, and to the point of businesses having to make payroll and things like that. Plus, what their argument is if we have to remember, it wasn't just Silicon Valley and Signature, it was Silvergate, right, that had wound down its operations. So the argument, the FDIC chair, what Grunberg said is, we just had Silvergate wind down operations on like the 8th, right? It was like a Wednesday. Friday, we see SVP come down. Signature on Sunday was going down. What if there's like some contagion risk? So with that small bank example, let's call it small, mid-sized community bank example, if there was a contagion risk, like a couple other banks around it, then maybe they would have. But in principle, I don't think they'd save any one bank's depositors beyond $250,000 if there wasn't. But now you have, but this is a huge change again, Peter, because now you have people debating saying we should take the cap off, that just all deposits should be insured. That's like a regular conversation now in the US, which blows my mind because I've lived under this idea of, like, I try to say, like, you understand you're talking about insurance, right? I always try to remind people, FDIC's, like, if the bank fails, like, if you have a car accident, that's when the insurance pays in. Like, You mean no deductible, no anything, just anything could happen, you're going to pay? There's just not enough money in the system to protect. Why would anyone believe in that insurance regime if there's...
So you're now incentivizing people to take risk.
Yes, the moral hazard that, yeah.
And they also would have pissed off a few of their donors if they hadn't have rescued them.
Yeah. And I think it got and I think that's why ultimately with Signature Bank being closed by New York, and there were some questions about that, the one thing I think that's come up in this bank crisis is, what about those $4 billion of digital asset deposits that didn't go back out to the bank from, Signature, right? They held back that amount. And the Signet that supported a lot of the crypto asset companies. And I think the way the FDIC might look at it is they should be lucky they're getting any of their money back, because we protected all of their deposits. So yeah, we won't let them in the banking system, but we're cutting them a check for $2 billion. Good luck, Godspeed. They don't see it as a problem. They're just saying we don't want that kind of risk in our banking system.
And this is the new paradigm we're in now. It's almost like in every scenario, wherever there's risk or failures or breakdowns, there's this infinite money printed to fix the issues.
There is. I will say, to your point, and I think it's very interesting, is the idea that Tether is attractive, right? Because Tether is something that can be accepted by a lot of people, right? It's proving itself as that medium of exchange. Tether's really just backed by the US dollars that it has. It's sort of that whole concept of proof of reserves that came up. So the Tether is an interesting proposition, that USDC is trusted so much by many, and then it sort of broke its peg, but now trying to move along and say USDC is okay also. These are, I use these stable coins with my business and send it in and out for payment. I did it just the other day, so it's not something that should be, necessarily a bad thing that we're looking to these. It's what's interesting is the type of US dollar that we're looking for, right? It's no longer the $100 bill or the cash in the mattress. It's on your thumb drive with Tether, right? Because you don't know what's going to happen with the bank, but if you have Tether, it technically is a bearer deposit.